A U.S.-Iran war does not need to destroy oil fields everywhere to shock the global economy. It only needs to threaten the routes that oil depends on. That is the real market story. The biggest danger is not always lost production. It is interrupted flow. And nowhere matters more than the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the open ocean. A huge share of the world's oil passes through it. If that route is threatened, markets react fast. Because when traders think oil cannot move safely, they stop pricing oil as normal supply. They start pricing shortage. That is why WTI crude has jumped so quickly during the U.S.-Iran war. Even though WTI is a U.S. benchmark, oil is still a global market. If Middle East barrels are disrupted, buyers look for replacement barrels everywhere. That extra demand can push up U.S. crude prices too. So a Middle East conflict does not stay in the Middle East. It spreads through shipping, supply chains, and global pricing. This is the chain investors watch. War risk becomes supply risk becomes higher crude prices, and higher crude prices become inflation risk. Once crude rises, gasoline and diesel often rise too. That means the shock can hit consumers, freight, airlines, and industrial companies. That is why this is not just a geopolitical story. It is also a market story. Energy stocks may benefit. Transport stocks may come under pressure. Bond markets may react if inflation fears rise. So the key question is simple. When will oil resume flowing through the Strait of Hormuz? Because when flow stops, price becomes the rationing mechanism. And that is the real reason a U.S.-Iran war can send WTI crude sharply higher.